Hello everyone, welcome to another edition of Skybound Capital's podcast series, Under the Macroscope. Now this is an episode that I've really been looking forward to because we welcome from ETM Analytics, George Glynos, with whom the company has a close association, and we really hang on his every word. It's always fascinating to get George and ETM's take on what's going on in the world, and true to form, Under the Macroscope really does take a look at global macro issues. And we're going to ask George for his view on some of those, and more specifically, how they're having a tangible effect in South Africa at the moment. George, great to have you on the podcast. I think one of the topics that dominated this podcast for much of last year was looming global inflation. It has come to pass. And indeed, there are additional factors that have come into play that perhaps no one could have predicted, which have just served to enhance the inflationary outlook. What is your view on the inflationary trends globally at the moment, and more specifically, how they're affecting South Africa?
Thank you, Matt, and thank you for that introduction. Good to be with you guys. Looking forward to this discussion. The topic of inflation, you're quite right, was a fear long before it became a reality. And I think there's a little bit of context required there. We as economists fundamentally view inflation as more of a monetary phenomenon than the straight out supply versus demand argument. So we think that before you get to the supply versus demand argument, you need to understand the backdrop of the monetary environment that exists. So the basic principle here is that inflation will only materially manifest if the monetary space exists for that inflation to take hold. In other words, if you've got tight monetary conditions, it's very difficult for inflation to rear its ugly head. If you've got very loose monetary conditions, you've got a lot more space for that inflation to take hold. In the case of COVID and the pandemic, we saw a very swift and colossal response from the major central banks around the world, led by, of course, the Central Bank of America, the Federal Reserve, closely followed by the European Central Bank, and you had other major central banks such as the Bank of England, the Bank of Japan, Bank of Canada, and others. So you had a very swift response, and to give you a little bit of perspective as to how big the response ultimately was, following the financial crisis of 2009, it took these very same central banks collectively about 10 years to build their balance sheets by approximately $10 odd trillion. In the space of just 18 months from the start of the pandemic in March 2020, they were able to build their balance sheet by a similar amount, if not slightly more. So what took them 10 years, they managed to concertina into just 18 months. Now that is just an enormous amount of liquidity and monetary stimulation to apply to a global economy in an extraordinarily short space of time. So you've got all of this wall of stimulation and monetary space that hits the global economy all at the same time. And it's actually quite difficult to absorb. So you have this huge huge stimulation that arises, and of course it does start to kick off a credit cycle. The credit cycle does start to gain a little bit of momentum, and all of a sudden you see money supply growth rates in your developed economies, again most notably America, rising rapidly into double digits, and in the case of the US, they were recording M2 money supply growth of 25%. Now for an economy the size of America, you get growth rates of 25% in money supply. It's just unbelievably huge. By contrast, you look at South Africa, and at the same sort of time, we were producing growth rates of somewhere between 3 to 6%. So you're contrasting this 25% rise in money supply in America versus, call it a 5% money supply rise in South Africa. And immediately that starts to have a range of consequences. Some of those consequences were very distortionary in nature. So immediately you started to see equity markets starting to rally. You saw bond markets performing quite well. And yet we were in an environment where the global economy, for all intents and purposes, actually stopped. It stopped, yet you still had these stock markets going record to record, and you had bond markets performing actually quite well. And it was about the central bank stepping in and purchasing a lot of these assets. Now, that's all very well and fine, up until the point where some of that stimulation and liquidity eventually starts to seep into the underlying economy, and it does so through the credit cycle. Not only have private sector balance sheets strengthened and created some confidence in that economy, but you get the lagged effects of that stimulation filtering through via the government and other channels into the economy, and all of a sudden you've got this very strong demand environment. But it's sprung out of a very stimulatory environment that the central banks created in the first place. Hence their response that we're seeing at the moment. So they're trying to unwind a lot of that stimulation because they've realized the effect that it had. So insofar as the inflation episode is concerned, yes, we're seeing a very strong inflation response, and it hasn't been helped by the fact that we've got a war that has created some deficiencies in not only supply chains, but the supply of some very important minerals and energy and the like. Over and above that, we're still not over COVID, and you can see what's going on in China, and they're locking down hard. So there's concerns there that there's going to be supply chain disruptions. The combination of all of that means that we have a tinderbox, if you like, that's been lit. And the tinderbox had a nice dose of petrol poured all over it in the form of monetary policy. And so that's lit, and inflation is firing up properly. And at the moment, we're living through the worst of it, I believe. So I think with the ultimate response of these central banks, we'll probably see it peaking around these current levels and drifting off a little bit later on this year. But it's undoubtedly true that inflation was driven principally by the monetary policy that was implemented, followed by an unfortunate set of geopolitical developments and COVID pandemic type developments that collectively just added fuel to the proverbial fire, and all of a sudden we've got this inflation episode. South Africa contrasts with that, right? So whilst that's very much an international picture, in South Africa we've got low levels of money supply growth. We've had, as a result of that, we haven't had the kind of inflation simply because we haven't had the monetary room to accommodate that inflation. Even though we've had fuel prices rising and all of that, it hasn't filtered through to the extent that it has internationally. And I think that goes to show that conservative monetary policies do protect the value of your currency. And hence we've had a rand that's staged an impressive recovery through the course of this year.
Let's just pick up on energy. You speak about throwing a dose of petrol onto a tinderbox. Well, at the moment, that dose of petrol is costing more than it has for quite some time. But energy as a sector, we've spoken on this podcast with Jabir Sadawala in our London office about rising energy prices in the UK, specifically around heating and gas. In South Africa, with this fuel price increase, which has been the result of a number of different factors, we know how dependent we are on our roads in our supply chain, given the failure in many respects of rail in this country. The oil price, where it is at the moment, how much of a medium to long-term effect do you see that having?
Oh no, it has far-reaching consequences and very deep rooted consequences and effects. So in the case of South Africa, again, you got to look at these things in context. So in an environment where you've got a lot of money supply growth and can accommodate inflation, the immediate impact is of course inflationary. In an environment like South Africa's, where your money supply growth isn't there, it's not so much inflationary as it is recessionary. So over and above the structural constraints that the South African economy faces, you now add to that mix this huge increase in energy prices. And by the way, it doesn't just stop at oil and fuel, because just remember, over and above what's happened to those standard, you mentioned gas, you mentioned oil, also comes coal. And if you have a look at the coal price, you'll be amazed to see that the coal price has risen even faster than the oil price, which has serious implications for a coal burning power producer like Eskom. So all of a sudden you begin to realize that the consequences are vast, and they're quite a lot more widespread than just the petrol pump experience that we all suffer through. So it is recessionary. It's like an added form of tax that's leveled on the average household that now has to pay literally double what they were paying about 18 months to 2 years ago for fuel. And so it does impact. It impacts very, very heavily. And so not only does it detract from growth, it does keep your prices elevated, which of course encroaches on your disposable income. And then on the other side, impacts the productivity of the country, not just because Eskom's going to struggle, but because companies more generally have to fund themselves and mitigate the effects of Eskom load shedding through the running of generators and their own supply chains of energy, so that they can remain productive. So across the board, you begin to get a picture, Matt, of just how devastating this can be, and why, in South Africa's case, it ultimately ends up being more recessionary than it does inflationary.
As usual on the podcast, if I can just take a pause there, we encourage you to get in touch and ask any questions you may have of the Skybound Capital team, and indeed of George and the ETM Analytics team. It would be fascinating to get your comments and your questions. I'm going to pick up on one, George, if I may, that you've just alluded to, and that is Eskom's power supply. I guess one of the blunt questions that everybody wants an answer to is why is there no greater will in terms of alternative sources of energy? We've been through many rounds of applications in South Africa for the production of renewable energy, primarily through solar and wind. Why is there not more acceleration in that space?
Well, I think you come out of a political environment that has been quite centralized. It's the way they've wanted it. There was a distinct lack of confidence in the private sector to play a material role in resolving a lot of these issues. Of course, that's had to be revised because the government simply has run out of money and has run out of the ability to borrow money in order to continuously plug these holes. Our debt to GDP ratios, for example, have risen to such a degree that it's just not feasible for the government to borrow money in the way that it used to. If one has a look at the Eurobond issue that happened just a few days ago, South Africa was forced to issue internationally at around 7%, which is enormously, that's very high. It's quite punitive for South Africa. And so that's not particularly, that's not an attractive proposition for the country at all. Because just remember, you borrow that money, but now you're exposed to the currency risk as well. And you're doing it at levels that are arguably quite strong in rand terms. Not a good combination. So I think, again, when you have a look at this, I guess a little more holistically, when it comes to Eskom, I think it's been a reluctance on government to include the private sector. That is changing, though, Matt. We have seen some indications of that changing, and thankfully so, because we're going for bid window 5 on renewables. That's going to bring some more energy into the mix. Private companies are now able to produce their own electricity, and whether that be through solar panels or their own generating equipment, the mines will be able to become a little more self-sustained and less dependent on the grid in the way that they were. So I think we moved in the right direction. They've also split Eskom into 3 and allowed the generation section, the generation company, to be able to purchase on a least cost basis from producers. So we're starting to privatize by stealth, not by selling off assets so much as just allowing the private sector to be included more, which I think is really constructive, and it's a move in the right direction. But it's taken a crisis for this to happen. The ANC government would not have done so willingly. Because it's just not in their it's just not in their ideological and philosophical view of how a developmental country, whatever that means, is supposed to run. So they believe that developmental means that government has to pull the levers and be involved in every aspect and facet of society, when in actual fact, what could be more developmental than growing your economy more rapidly and making it more self-sustainable through the crowding in of the private sector, which ultimately pays more taxes. So, I think it's been a big ideological issue for the longest time. But if it's one good thing that comes out of a crisis, is that it forces an administration to rethink its position and its strategy, and to consider alternative ways of perhaps achieving its end goals. In this particular instance, happy to report that it seems to be turning more towards the private sector.
So, notwithstanding the fact that it's been reactive as opposed to proactive, if we see some positive outcomes, do you then see the potential for a change, perhaps in political will, which we need in order to provide the stimulation that the economy requires?
Matt, but political will is an interesting one for me, because I don't. I tend to have a very cynical view of politicians more generally. And I think political will only really arises when it threatens a particular outcome or objective that politician might have. So I see very few of them as benevolent in the true sense of the word. And so ultimately, what I tend to find, and there have been many examples, especially post the 2009 global financial crisis, of significant regime changes that have taken place, not because the incumbents were so brilliant that they had to be chosen, so much as it was a population seeking change. And so the ultimate objective for politicians, in my opinion, is to remain relevant. And to the extent that shifting policy achieves that relevance, then I think what you term political will arises. But without that catalyst to get that going, without a groundswell of frustration at the inability of a government to be able to deliver on its promises and objectives, without that groundswell, I think it's very difficult. So at the moment, what have we got? Well, just middle of last year, we had those terrible riots and protests in KwaZulu-Natal. Since then, we've had some really difficult economic times, and I think it's not just coincidental that all of a sudden this government is now looking to reform and to bring in the private sector. Quite simply, I think they were out of options and didn't really have another credible alternative strategy to be able to adopt in order to try and keep this economy on track. Well, not that it has been on track, but I think there's now more appetite for reform than we had. But that's not a function of Ramaphosa and his administration being, all seeing and wanting to do the right thing, so much as it's been forced on them.
Perhaps we can finish, because time has absolutely flown, as it always does with you, George. We touched on currency earlier in the podcast, and there's been a fair amount of volatility actually in the currency markets in recent weeks, in particular. Where do you see equilibrium for South Africa's currency?
I mean, I never thought I'd say this, Matt, but Rand really is trading like a safe haven currency at the moment. And that's probably because I think investors are treating it as a bit of a proxy for the commodity cycle. And commodities, as we all know, are rocking and rolling at the moment, doing extremely well, and obviously boosting South Africa's terms of trade. So you've got a set of star alignments, if you like, that have come to pass, that have moved in South Africa's favor. And it's, of course, fundamentally about what's happened at the commodity level, which has boosted terms of trade, which has boosted South Africa's trade and current accounts into surplus, which we've been able to sustain. At the same time, we've had a weak domestic economy, which has constrained both consumption as well as investments. Our imports have remained under considerable pressure. Again, a net positive for Rand. In and amongst that, you've had fiscal risk, right? And investors have priced for fiscal risk, and the way they do that is through higher interest rates, which has raised South Africa's carry attractiveness on that front. And then you've got other peculiarities, such as what's happened to Russia and what's happened to Turkey. Both of those currencies becoming a lot less investable. So your spectrum of emerging markets currencies that you can expose yourself to and invest in has shrunk, and of course South Africa potentially benefits from that. Then you can delve into inflation differentials, and it's not often I can say this either, but South Africa's inflation is well below those of America and the UK, for example, at the moment. And from a purchasing power parity perspective, that pushes, that supports Rand. So it's multifaceted, Matt, that we've got a lot of factors that have come to play kind of at the same time. That have boosted the performance of the Rand. And so now we're sitting in what we consider to be a mildly overvalued position, which is quite extraordinary if you consider that we're sub-investment grade and a country that faces many of its own challenges, and yet here we are. So I think it really is a function of the commodity cycle, but herein lies a caution in that if it is about commodities, bear in mind that these events tend to be quite cyclical in nature, and that this too shall pass. As good as this has been for the Rand positively, at some point in time, when geopolitical risk subsides and the global supply chain network starts to normalize, I don't anticipate that commodity prices are going to remain as elevated, and of course that naturally has consequences for Rand.
George, as always, fascinating. We could carry on for hours, I suspect, but I'd encourage those subscribers to the podcast or those who perhaps listening in for the first time, if you've got questions and queries, do get in touch. The Skybound Capital email and website addresses have been available during the course of the podcast. I think we'll put them up again now as well. And I'm sure you found everything that George has had to say really interesting and stimulating. And I'd encourage you to take a look at ETM Analytics as well. And as I say, do get in touch if you have further comments or questions on our discussion points today. The Under the Macroscope podcast series is available on Apple, Spotify, and on the Google podcast platform for Android. And all past editions of Under the Macroscope are available at www.skyboundcapital.com. George Glynos of ETM Analytics, as always, great to chat. Thank you for your time, your insight, and your knowledge. We do appreciate it.
Thank you, Matt. It's been great touching base with you guys again.
So until next time on Under the Macroscope, have a great week, everyone.